get started here. My name is Justin Krieger. I'm the head of financial planning at Client First. Thanks for coming out this morning. Before we get started, we always like to, well, Eric likes to do jokes. Paul and I like to do trivia. So I'm doing trivia this morning. So trivia this morning is, in 1995, what did they predict we would have in the world in 2025, 30 years later? So there was a BBC show, and they did some studies on what they thought we would have. So big things in the world. So anybody take a stab on what, in 1995, what they thought 2025 would look like? Flying cars. So that was from Back to the Future. Different movie. So here's some fun things that they thought would be out there. I'm not going to cover all of them. So they thought that by the year 2000, that the internet would be taken over by business barons and banks, and there would be cyber riots in 2005. I'm not sure that's quite come true.
Is that called Twitter?
I don't know. So that's one thing. Another thing they thought was that we would be mining for precious metals, mining asteroids in space. I know that's still an idea, they're working towards it, but we're not doing it yet. And then there was also this idea that there was going to be so much space junk floating around in space that was going to be dangerous and hit the Earth. And the solution they thought would be this foam or gel that would grab all the garbage. So I don't think that one's come true yet. The last one I'll cover is they thought that the best surgeons in the world would not. So the example they give is there's a really good, hand surgeon in the UK. He might do surgery on someone in the US using the internet and using a robot there. So we're not quite there, but we definitely use robots to do surgery. So that one's pretty close. So a couple other ones, interesting to think what might happen in the future. So if you're like me and you're a fan of the movie Terminator, I'm a little bit scared of AI at this point. So, and many of the young kids have not seen the movie, so I'm like, go watch this movie. Movies normally come true, 20, 30, 50 years later. So with that, we'll get started. So a good quote to start off. So we like to think of investment management sometime as your journey through your life and into retirement. So here's a quote: "Good cars get you from point A to point B, but it's a great driver that gets you there safely." So very important. With that, I'm going to introduce our Adaptiv investment management team. So we have Dave, Ian, and Kevin this morning. What sets us apart from a lot of other firms is I'm part of the financial planning team, so we have dedicated teams of professionals. So these three team members, 100% of their focus is on investment management for their clients. They're not tax experts, they're not financial planners, they are focused on their specialty. So we're very grateful to have them as part of our team, and they're going to take you through one of two updates that they do each year for our clients, and it's been pretty interesting lately in the market. So with that, I'll hand it over to Dave.
So I'm a little nervous this morning, and you might be like, yeah, you're presenting, you should be a little bit nervous. But it has more to do with, I grew up, I'm not really a great fashion guy. You might be able to tell that from time to time. But I grew up thinking, how can a guy wear a black suit coat with brown shoes? So I consulted the process, checked with my wife this morning. I also checked with Google, and it said I can. So here I am. And I think it looks pretty good. It's not bad. So I just trust the fashion process. I always have to start with this presentation is for education purposes only. Many of you are our clients, some of you aren't. Those of you who are our clients, we know your financial situation. Those of you who are not, we're obviously willing to meet and learn about your financial situation, but nothing in this is about promising for the future, even if it is mining for minerals on asteroids. The presentation today, as Justin alluded to, we have different expertise on the team. We're trying to build this family office concept that typically is reserved for billionaires, which is they have their own attorney, their own CPA, their own investment person, all these levels of expertise. We're trying to build that for everyday Americans. And today we're going to be covering the adaptive investment management process. So our agenda for today, what is price? That's a little bit of an abstract question, right? What does that mean? Why would you say it like that? We'll go through that. What is our adaptive process? What is relative strength and how is it different? Kevin's going to come up and talk a little bit about that. Ian will come up then after that and talk about the ETF that we run on behalf of our clients, how it's performing, how it's doing, any updates there. Then we'll have a panel question time where the three of us will be up here, and that's a great time where if you guys have questions, it can be about anything, almost anything. I can't tell you what the brewer's record is going to be, but you could ask about tariffs, geopolitical, you name it. We may not give you an answer you like, but you can ask questions. Justin will have some questions too if there's no questions from anybody. Then we have the risk management game plan. That's what I always like leaving people with. And a mandatory part of the presentation towards the end of your packet, there is a question where you scan a QR code. And so I'll walk around. I'm actually going to pause the presentation. If you've never scanned a QR code, I'm going to show you how to do that. And you're going to rank us on the likelihood of how likely are you to refer someone to this type of presentation. So I'll walk you through that when we get to that part. But that's the only thing required of you today other than to enjoy breakfast and the information we're providing. All right. I always like starting with a little update on family news. This is a big one. My son, Micah, he's our youngest. So you can see that I have some white in my beard. We have 4 children. But this is very exciting. He was just confirmed on Sunday, Palm Sunday. And tomorrow, Monday, Thursday, gets to have the Lord's Supper and receive the forgiveness of sins. So it's a pretty big deal in our family. We're pretty excited. We trust the Holy Spirit's process. He's been at work at Micah since baptism, and here he is, taller than me, the knucklehead. But it's a good thing. All right, jumping into our presentation, what I'll be covering with you are 2 of the pillars. Kevin will be covering the 3rd, but these are the 3 main things that drive our process when we look at markets adaptively on behalf of our clients. Price and trend. Yeah. And it sounds a little bit abstract to say, hey, we study price. So I'll go through what I mean by that. It also sounds a little cliche to say we identify trends. So I'll go through what I mean by that. And then relative strength is this concept of I'm rounding, there's about 35,000 different things we could invest in on behalf of our clients. So how do we possibly pick? Or not pick, just as importantly. So first and foremost, price. Again, abstract. What is price? Well, it's just an agreement between a buyer and a seller on the value of something, right? When you have a neighbor that sells their house and they come to an agreement on a price, you can disagree. I hear that all the time. I can't believe they got that price for that house. That's ridiculous. Doesn't matter. Buyer and seller agreed on that. That type of transaction is happening on a minute-by-minute basis within the market. Bond market, stock market, commodity market, crypto market. Buyers and sellers constantly interacting on the future prospects, right? Someone buys a house because of the future prospects of it. This is going to provide shelter and location for my family for the next 10 years. Markets are similar. It's not necessarily about what's happening today. It's about what's happening 6 to 18 months in the future. So it's a weighing machine. And one of the tools that we use is something called a candlestick. And it's called this because it looks like a candlestick, right? It's got a body and a wick on it. And to explain this further, if this were a day's worth of price, what this is describing to us visually is this is where the day opened at price. This is where it closed. The whole day, though, it covered this amount of price. So this is a positive day. Here on a red day, we opened here, closed here, and price moved in between. And we track this information going forward. So here's an example. We're just going to make up XYZ stock opens at 50 bucks, goes as low as 49, as high as 53, closes at 52. Great. Good information. What's all in there? Like, what is going on that causes price to fluctuate like that? Everything. All opinions. They could be rational opinions, like really good thoughts. Someone has really good material understanding of that particular industry or company and how it looks and their balance sheet and their cash flow. There's also irrational opinions. There's moods and feelings. There's guesses, shrewd and otherwise. Only price reflects all information and opinions of all market participants. It is the manifestation of opinion and final arbiter of value. If you're gonna print something out today or take it home, this would be a slide to take home, that only price matters. Because really, it could be anything. If someone could be selling a stock because they don't like the dividend, they don't like the product, they don't like the balance sheet, or they need to remodel their kitchen. All these things are reflected in price. Same thing with fundamentals. Earnings, PE ratio, sales growth, GDP, tariffs. We're all familiar with that one for the last few weeks, months. Tariffs. But so are these other things. You're just making a deposit through your 401k that buys an S&P 500 fund that's owning Apple stock. You didn't make some like really intelligent decision other than you should be saving. That's a good decision. But on why it's buying Apple. So all of these things are reflected in price. And that's why we track it. We don't, as part of our process, we don't get caught up in the day-to-day narrative that the financial news feeds us, because you do realize that they don't have your best interest in mind. Their job is to sell razors and cars. Like they have to make investing entertaining so that they can sell you commercials. So for us, when we use price, what I have up on here now is the S&P 500. Think of it as a basket of 500 US stocks that are a good representation of what's going on in US equity markets. It's not exactly 500. Fun fact, it's actually 493, but that doesn't sound as fun. S&P 493 doesn't have that good sound to it. But on this particular chart, which goes back to the end of 2021, are 946 of these. So we don't look at just day to day. We want to be looking at trend, because if we looked at it day to day, it would be a little bit difficult to decipher what's going on. So it matters visually how you're looking at the data. So if we put the data like this is actually 2017's daily moves of the S&P 500. It's actually one of the least volatile market years in history. But did you know that from 1951 through now, the percentage of up days, 53% of them are up and 46% of them are down? Now, if you were just to look at the daily movements, you're now feeding into your what's called loss aversion bias. And loss aversion is simply, you feel way worse when you lose $100 out of your wallet than how good you feel when you find one on the sidewalk. We just do not like that pain. So if we only looked at the data like this, 2017, the market was up about 20%, 25%. But this would feel awfully painful because the days of losses would feel so painful. So we have to use other tools to help us get past those biases. And one of those is simply using a chart and then adding this blue line that's on here now, which is the average of the past 200 days of information. So think of the price recorded each day for 200 days. You divide by 200. Each day, a new data point gets added onto the blue line, and that gives us a trend. That looks like this. And this is important because it helps us remove ourselves from loss aversion and helps us understand who has control of the market. Quite simply, supply and demand, more buying than selling, what happens? Price goes up. More selling than buying, price go down. So we have 200 days of information showing us there's an uptrend. Okay, buyers have control of this market. That's a good thing. We want to participate in that. If I put my face on this screen and tried to present to you, I wouldn't do a very good job because I wouldn't be able to tell where I am. By stepping away and looking at 200 days of information, it gives us a really good idea of who has control of the market. And then we have a process based on this. So the blue line that I've been highlighting before is 200 days of information. The orange line that's on here now, I hope it looks orange in your packet, it doesn't look as orange on the screen, is the past 5 days. So you have a short-term trend and a long-term trend. And quite simply, when orange is below blue, that's when bad things tend to happen. It's not a guarantee of bad things, but every time a bad thing in the market happens, it starts with that characteristic. It's very similar to saying to someone, you can drive in a snowstorm. It does not guarantee an accident, but I think we'd all agree that the odds go up. And so our process is about when the odds go up of high risk events, we want to detach ourselves. We want to park the car. We don't want to be involved with the market. So when orange is above blue, we enjoy the ride. We participate heavily with our clients. Our clients are familiar with the performance from last year. When orange is below blue, we want to park the car, which is the way we are right now. We're holding high levels of cash, T-bills that generate about 4.5%. T-bills are a shorter term instrument. They don't move very much. They're very flat line, but they do pay a coupon. We like that. And we can have patience during this time. We have orange below blue. We got out of the market March 15th, March 17th of last month. We've been holding high levels of cash. We're inside during the snowstorm. We're okay with that. Because I like to give the analogy, because right, the industry says you should just buy and hold through this, which I think is a little bit ridiculous. And I'll give you an example. So this is my commute. It's an awesome commute. I live in Jackson. This is our office. I have a couple different ways I can go home. Depends on how I'm feeling. It takes about 15 to 16 minutes on average. But what if I told you I found a loophole that I can get home on average 10 minutes? Your spidey senses should immediately be like, what? How are you doing that? Well, I run every red light and I keep my foot on the gas. Right? That's buy and hold. But you would tell me, Dave, that's really irresponsible. You could kill someone, and you would be right. And that's the same thing in markets. Are you really just going to put the cruise control on and fly through red lights when the market is in a corrective mode? No, that's not appropriate. It's not appropriate for our clients. So our main attempt with this process is to mitigate those downside moves in the market. We don't just put our foot on the accelerator. There's a time for that, and we've shown that in previous markets, but not right now. And I call it buy and hope. It's not buy and hold. It's not a process. And this is a really important chart to digest. What this is showing, because the media likes to say things like, the reason why you need to buy and hold is because you might miss out on the best days. That's a true statement, but a half-truth, which is also a half-lie. You also miss out on the worst days, because statistically, the best days are neighbors with the worst days. Look at the last few weeks. Huge move to the downside. We had a 9% move to the upside on one of those following days. One of the best days in the past 20 years. But if you weren't involved with it, you'd also miss the worst days. And this chart shows that if you're fully invested since 1990 through current, return is about 7.9% in the S&P, but you have an 18% volatility. If you missed the 100 best and worst days, your return goes up and your volatility goes down. That is why we use our process. That is why we use those orange and blue rules to identify, okay, now's the time to park the car. We don't need to be involved in this. There will be a time again. I wish I could tell you when it's going to be. I wish I could tell you when the orange will cross back above blue. I don't know how long this market correction will take. We could be buying stocks again in 2 weeks, 3 weeks. Could be 6 months, could be 12 months. I don't know. But it's important to identify when risk is too high and when we need to protect client accounts. So the third part of our process here that I'm going to invite Kevin up for is this process of relative strength. So price and trend is telling us when to be involved and when not to be involved. Our relative strength process is telling us, okay, when we have clear skies, when we could put the cruise control on, what should we be involved in? Kevin's a rising star at our firm. He has a chartered market technician designation. There's only about 4,500 of those in the world. And he and Alicia, his wife Alicia, just had their second child, Case, who I hear is just an angel. So please give a round of applause for Kevin.
So like Dave mentioned, we had a wonderful addition to the family. So you can see Case there on the left. And yeah, he is a little fussy. Which I kind of had an idea was coming, because our first one, Colt, you can see right there, the happy brother, was pretty easy, I guess, relatively speaking, which I think is probably the case for most of the first kids, because that's how they suck you into the second one, right? So yeah, that's kind of evening out now. We're back to normal. But yeah, it's definitely been fun getting used to not that much sleep again. And thankfully my wife's not listening to me talk. She would probably argue that I get more sleep than her, which is probably true. But yeah, it's been fun. I do hear a lot of crying and screaming now throughout the day when I call home and see how it's going. So that's, believe it or not, it's really not that bad being back at work. But don't tell her that. So, relative strength. I feel like we covered this topic quite a bit in different ways. It's part of our initial adaptive education for prospects and clients, things like that, but pretty important concept. If you've seen our education, initial education before, we always talk Coke and Pepsi, right? That was kind of the standard we've used, ever since I've been here, so going on 9 years. But relative strength, Dave essentially, kind of touch base on what that is, or I guess what it does, right? When you talked about trend, you mentioned there's 35,000 things out there within the marketplace, right, that we could own on any given day. In a uptrending market with broad participation, 15, 20,000 of those things keep going up, right? But, there's only 8 hours in the day the market's open. It would take me probably a week to buy all 15,000 of those things, right? There's just not enough money to go around. It's not feasible. So how do we figure out, what 5, 10, 15 of those 15, 20,000 things go into portfolios? Well, we look for relative strength. And the way we're going to walk you through how we go about determining that is by using Ford and Ferrari. So that was a movie you can kind of see here. I will say I'm slightly biased on one side of this than the other. Ferrari's my last name. Definitely pulling for it. But I have driven a fair number of Fords in the past, so I can kind of hedge my bets there. So step one, right, if you're, as we're, analyzing markets, securities on the surface, right, we always start with, we call it the absolute chart, right, the individual security itself. So in this case, this is Ford's chart here from kind of, we'll say mostly 2021 through 2025. So a fair amount of time. You can see Ford in this case had a pretty good run up into 2021, leading into 2022, kind of leveled off, right? And the way we talk through these examples is always using past amounts of history, years worth, right? But we're doing this in real time, which is a little bit more unique. So, if you kind of focus on the end of the chart here, when you compare that with Ferrari now, hey, it looks a little better, right? Pretty decent start, same time as Ford did. Had a little bit of a, kind of trailing off 2022 and 23, but finished the year pretty strong. So, if you were just looking at these two charts, right, how do you determine which one to buy? When it just kind of looks like it's moving up and to the right, is that how you determine it? Not always, right? In this case, at the start of the chart, they're both moving up and to the right. So the way we go about, kind of solving this problem and trying to be objective in that process is to turn this into a math problem, because everybody needs more math in their life, right? It's a very wonderful thing. But what we can do is take the price of one and divide it by the other. Pretty basic concept, right? And by doing that, this creates a ratio, which is generally a scary word, right? Especially when you're helping your kids with homework. But all this ratio represents now is this relationship, which we can chart over time, right? So now this chart represents Ford's performance, right, relative to Ferrari. So in this case, when this ratio is moving up and to the right, what does that mean with the way we have this set up? Yeah, Ford's doing better, right? And when that ratio now kind of levels off and moves in the other direction, the opposite's now the case, right? Ferrari is actually outperforming Ford. Way to go. Trick is, right, if you think of this, right, compare us into terms of like a buy and hold system, you know, it can be kind of hard, I guess, to get this point across when you look at some of these really long-term charts, right? I mean, you're talking multiple years worth of outperformance by Ferrari, right, towards the end of these last few years. When you kind of zoom in where we're looking at these things more so in real time, these relationships have a much greater degree of change and movement back and forth than sometimes when you really take a step back, right? And there's, you know, these relative relationships have risk built into them, right? There's always opportunity risk. So if you pick the wrong side of this relationship, you're giving up returns potentially on the other side. So these relative relationships are active, continually changing, which is why, you know, really this represents a lot of kind of the day-to-day, week-to-week adjustments that we make within portfolios is because of this concept. You know, as these relationships change and fluctuate, you know, that leadership that we're looking for changes and we adjust with that. So what we can see here is the performance difference, just kind of that I mentioned before, which is pretty drastic. Right at the beginning of this chart, Ford up 108%, Ferrari, which has the greatest ticker out there, race. I mean, they win in the marketing department, I think. Only up 21%. I mean, both would be fine, right? If I could say I could buy something guaranteed 21%, I'd take it every day. But it's pretty tough if you leave 108% on the table, right? You know, kind of as this relationship started to change or evened out, they kind of leveled off. And really, I mean, this time period here represents like almost a year, right, where essentially these two were duking it out, not making any headway one way or the other. So it's not like there's always a clear leader with these relationships either. So in this case, if we were within that environment, it might look like there's really no point in owning either of these Ford or Ferrari. We'll look for something else relative to these two that show the same type of performance. And then to the flip side, you can see how much better Ferrari did from there. Now, what does, you know, relative strength or outperformance mean? Like, do you think as a process we can essentially skip, you know, just looking at these individual charts and look only at the ratios, just buy whichever one's outperforming at that point in time? Or do we still need to kind of look at the absolute chart?
Well,
What is it?
buy when it's low.
What? Yeah, it's
You
true.
don't buy when it's up on top,
Mhm.
because it's got nowhere to go but
Nowhere.
down.
You never know, though, right? I mean, new high. There's nothing more bullish than new highs. You know, I don't think there's necessarily really such a thing as too high of a price or something on a chart. You see everyday things just keep going. But, you know, when, you know, this is, you know, Ford's underperforming Ferrari here, that can look multiple different ways, right? Ferrari showing relative strength during a bear market or correction could just mean Ferrari's going down less than Ford. Doesn't mean you necessarily want to buy one or the other either, right? So you still have to keep the absolute chart in mind when we kind of make some of these relative strength decisions, because something's going down less than another thing isn't really a good reason to buy. But it is definitely kind of a good thing to watch for when kind of the market turns back around, like now. So now, for instance, you know, we're in cash. Do we just kind of sit there and scroll through news, watch ESPN clips? And we're still looking at, you know, the entire market, looking at these relative relationships to kind of get an idea, you know, where we want to key in on when we eventually can participate again. But this is just an example of two individual stocks, right? Are we sitting there looking at all, you know, 35,000 things individually, right? 15,000 charts a day? Not really, because I'd never be able to go home. So the way we apply this concept of relative strength is in what they call a top-down approach. And really, what we're doing is taking the market, which in this case is essentially a loaf of bread, right? And we're splitting it up into larger buckets and sections that we can weigh against each other to kind of narrow down the areas of the market that we want to look at. And like bread, apparently, there's multiple ways you can kind of segment the market up. So we can look at it, you know, as far as like market cap, so the size of the companies out there, large caps, biggest, mid cap in the middle, right, and small caps, and vice versa. So are we in an environment where small caps are outperforming large caps? For the currently last few years, that hasn't been the case. So that kind of lets us take this top part of the bread, which is the best part anyway, and kind of focus on those large caps. Okay, that helps you narrow it down a little bit. But you can also look at kind of these vertical slicings here, which are the sectors within the market. Right, there's 11 major sectors. Which large caps in those specific sectors are outperforming the others? And really the number of computations and ways you can look at this is endless. If it's got a price, we can look at it this way. And we can look at this globally as well, right? I mean, they have bread everywhere in the world. Same thing with markets. From time to time, you'll see some interesting areas making it into portfolios. Argentina, Greece, China, a little bit, Japan. Using this idea of relative strength, comparing equities in some of these foreign areas to equities here within the U.S., we can identify those time periods where it makes sense to participate, abroad. But really, right, kind of the key point to this is, right, if you're in more of a buy and hold strategy, chances are you probably have, some set international allocation that's just there 100% of the time. And since I've been here, almost 9 years, I would say 90 to 95% of the time, international equities are just underperforming equities here within the U.S. So really the way we see it, why have, 5, 10, 15% of your money sitting in an asset that's underperforming 90 to 95% of the time? It just doesn't make sense. And especially if we have a way where we can identify when it looks like that leadership's changing and capitalize on it from there. So that's the point of relative strength. That's how we use it. And next, Ian's going to come up and talk about the Adaptiv Select ETF.
All right, thank you, Kevin.
Mm-hmm.
Thank you, Kevin. Round of applause. Relative strength is invigorating. I know you guys are thinking that. So as they like to do at Adaptiv, at Client First, talk about our families. Gosh, I haven't been here since October. So these are my two over here on the left, two boys. They will be 6 and 2 in July. It's at a park that we go to quite a bit. My oldest recently had a school project where they had to dress up as presidents. The kindergartners did. He was giving Bill Clinton. Well, we'll leave that. With, we can talk about that after the presentation. But it was really fun. It was really fun. And it's my wife and I a couple weeks ago at a concert we went to. So always nice to be able to get out and have spouse time. But yes, Kevin said we're going to talk about ADPV. If you are a client and statements, you should be pretty familiar with this. It is an ETF that we developed for our clients. It debuted the end of 2022, around November 2022. We started that. It took us about 9 to 12 months to put that together from start to it being live to the public. I'd say 80% of that effort was probably legal and compliance, as I'm sure none of you are surprised. We used to run this strategy for clients, a very similar strategy for clients inside portfolios, where we would buy, 15 to 25 stocks, and it was cool, it was great, not the most tax efficient way to go about it. So putting it inside an ETF wrapper, way more beneficial for clients, and other advisors can use this with their clients as well. But yes, so same concept that Dave spoke to earlier about the 200-day. We want to be involved above a 200-day. We want to be in cash or cash equivalents, short-term T-bills when we are below a 200-day. So we talked market regimes. We talked about the 5 and the 200, right? So since this is the S&P since the ETF debut. This is not the ETF performance. but this is since it debuted here back in late 2022. We've had a few periods below where the 5 has dipped below the 200-day. And, you know, within a couple weeks, a month, we were right back involved in participating in the uptrend. What we're not going to do is we're not going to get to our any type of scenario and say, well, you know what, the last 2 were kind of fake outs. So let's just wait and see what happens with this one. We're not going to do that. So as Dave said, 3rd time since the ETF has gone live that we've gone to T-bills. That happened back here in mid-March, March 17th to be exact, on a Monday. So market went up a little bit after that, but has fallen since. So let's talk about real-world performance. 2024, very good year for momentum as a whole. We have MTUM, the red line. That's kind of the largest momentum ETF in the world. A few $1 billion in it. When people talk about what has momentum doing, this is kind of like the face of that, the face of how is momentum doing in the market. So also had a good 2024, S&P as well. Put a few time markers on here. We have the presidential election, the end of year. And so we get into 2025, and here you can see right here, ADPV cash trigger, it goes into short-term T-bills. It flatlines. The rest of the market has continued down since. We're down even more, some more this morning. And this also looks a lot like client accounts overall right now. Just flat. We are waiting out to see what the market does. Really no prediction on how long it lasts or anything like that. So let's talk about this real world performance. So over the last 1 year, among all U.S. funds, that's ETFs, mutual funds like that, ADP varies performance in the top 98%. Versus ETFs, top 95%. Sharp ratio, which is a fancy way that Andrews likes to say, how much return are you getting for the risk you're taking? So top 90%, 82 percentile. Stock market correlation. Now this is an interesting one because, right, this looks, if I was to show you these charts, they go up when the market goes up, the S&P, and they go down when the market goes down. But the true day-to-day correlation, and I would never expect clients to sit there and recognize this, but if you were to look at the fund on a day-to-day perspective, many times it is not in line with the market. Yes, it is in line with the overall long-term trend, but on a day-to-day basis, and it goes both ways. The market's down, the ETF is up, or vice versa. But overall outperforming, which is what we want to see. And if you are curious about the ETF, I know clients already get monthly newsletters, but there is adpvetf.com. If you listen to the podcast, should be pretty familiar with that. We do monthly write-ups. So if you're curious about what is being held inside that ETF, because when you look on your statement, those internal holdings aren't going to show up. It's just going to say ADPV, but there are 25 stocks inside of that. So if you ever want to look and see what we own, what you own as clients, you can do that. And how the fund changes month to month, how it compares to the other market, what trades were made. Yeah, I think it's a great product. And so that brings us to our Q&A panel, and let's invite Kevin, David back up for some questions.
So I have questions that I'd like answered, but before my questions are answered, we're opening it up to anybody who wants to ask any questions. Yes, Jim.
What does ETF stand for? You threw the term around, but I have not a clue what ETF stands for. So what is like a definition of it?
Looks like Kevin's taking that one.
Yeah, so ETF stands for Exchange Traded Fund. The way I like to describe it, because most people know roughly how mutual funds operate, right? It's a basket of securities within, one wrapper, essentially. They operate roughly the same. The only difference being mutual funds only transact once per day after close, take all the inflows, outflows, do a bunch of fun accounting things in the back end and kind of average everything out. ETFs Intraday operate a little bit more like individual stocks, so they transact on the open market, when the market's open. So they provide a little bit more flexibility, especially for us, right? As some of these things change within the market, we can react a little bit quicker. But essentially, they can operate roughly the same as a mutual fund, other than that.
I just want to add one thing that's very important for our clients is the capital gains handling within an ETF. So if you think about the stocks that were held in ADPV before they were sold, we had several that were upwards of 100% in there. If that were happening in a mutual fund, that sale, there'd be a cap gains distribution towards the end of the year that you would receive some type of distribution and that would be taxed. The reason why we love ETFs is that is eliminated. There's only a cap gains when you sell the ETF itself. And so for clients, any type of sale of a stock that happens in there, they're not getting cap gains taxed on that, which is a huge, huge benefit. I mean, after all, we're client first tax and wealth advisors. We're reducing the overall tax burden for our clients with that. That's a huge thing for us.
So on that, not eliminated, but delayed, and then our planning team can determine when do you want to realize the gain. So you're not forced into a year that you don't want it to
Correct.
be recognized. The other one, as long as we were covering abbreviations. Dave, when you referenced T-bills, did you mean U.S. Treasury bills?
I did.
Okay.
He's giving me a hard time because I'm not big on acronyms.
We got to take them back.
Yeah.
All right. Mom, my mom has a question.
So in this ETF basket, if you will, do you move stocks in and out of that on a daily basis, on a weekly, a monthly?
These planted questions, these are good.
No, this is for you.
So it happens Monday. It happens every Monday at the open. In theory, it technically does not happen at 8:30 in the morning. It happens around 8:35, 8:40, because there has to be some selling and things there. But yes, it happens every Monday, and we do not rebalance. We just reconstitute. So at 25 stocks, they're not all in there at 4%, and then we just let them go. We aren't in there every week bringing everything back in line. That kind of dumbs down the purpose of the momentum, so to say.
We let our winners run.
Our winners run, exactly.
If you have a guy who's got a hot hand in basketball, you let him keep shooting. Good?
Yes, thank you.
Mark?
Jason, all right. Describe for me in layman's terms what a volatile market is in terms of benchmarks, which you guys would call benchmarks. In layman's terms.
A market where you're seeing daily swings above 1%,
I think that's fair.
which we've seen most every day and again today for the last 2 months.
So I'm old at heart, so I listen to AM radio like my father every morning. So on the S&P 500, how many points is that right now? Because they don't
Points.
So on the radio and on the TV, they don't always reference. They don't reference
That's how they
percentage.
get you.
So what's
They
S&P?
use points.
What's S&P at right now?
5,200.
53.
So what's 1% of 5,200? Kevin.
Some 1% of 52 here.
52.
It's 52.
Yeah.
So anything over 52 points in a day. Because they say in the morning it's up 150 points or it's down. So they don't reference that. So I think that would.
Okay.
Is volatility only to the downside?
So volatility is one of those things where the media likes to use points because it sounds more outlandish, right? If you had a Dow Jones at 5,000 points in the 60s and it moves 500 points, and you say 500 points and the Dow's at 50,000 now, it still makes it sound just as dramatic when it's not. So we live in the percentage world, so that's why maybe we look a little stumped on like points because we don't talk that way. We use percentage moves, and what's interesting is that when you look at the data, volatility does increase at turning points. So tops and bottoms of markets, volatility increases. You see bigger swings in price movement. I don't know if that helps.
My last comment on that topic is they also, if the market closed at 5,000 yesterday and it opened at 4,500, but then it went up, they reference it according to what it opened at, not the closing prior day, so it's very confusing. Because they may, so they say, so market closed here, opened here, but popped up. In the morning, the news media will say the market's up today, but it's down from the prior day. So they're just confusing everybody. So that's my, there was the next question.
I think your pops had one.
Oh, Dad.
I just wondered what the odds are that Kevin's hairline is going to match Ian's Dave's.
Could you repeat the question? Repeat the question.
My father, in all reference, asked what the odds are that Kevin's going to have the same hairdo as Ian and Dave. Hairline, hairdo, whatever you prefer.
So Dave mentioned gray in the beard, and after child one, that already started showing up. So I'm thinking that's pretty likely at this point. It's coming. Yeah.
So I have questions. If anybody thinks of one, you can pop your hand up. I'll ask the one that everybody is thinking about. What are your thoughts on tariffs? One at a time, please.
Let everyone rush.
I would say thoughts on tariffs are all over the place. So from a personal, so I'm removing myself from process. Personally, tariffs. Prior to 1913, Americans paid little to no income tax, and revenue to the government was paid through tariffs, through trade negotiations with other countries. And we seem to do pretty well in that period of time as well. So now, tariffs today, I think we all agree that the trade deals that have happened since Henry Kissinger in the late 70s have not been beneficial to Americans themselves. You look at the Rust Belt in the Midwest, manufacturing that went overseas. Has that benefited Americans? I would say no. If you start enacting tariffs, is that going to be painful? Yes. I think it's harder when the person that's trying to negotiate these tariffs, media is portraying it as flip-flopping. But if you've read The Heart of the Deal, that's part of this. And does that affect markets? Sure. Opinions change on markets because the previous chart up there was the world is a flow chart for capital. So where is money moving? Tariffs have an impact on that. But the good news is, the reason why I can sleep at night is we have price charts. They can show us what investors are thinking about tariffs. And it might be near-term painful, but we've been through this before, 2017, 2018, where tariffs were negotiated, there were trade wars and things like that. It's happened before. You guys have anything you want to add?
As far as, do you have I'm going to go back to a chart over here. So tariffs were announced that it was a Thursday after the market closed, somewhere right in here. So we had already been in cash, and David mentioned earlier his example about driving during a snowstorm and the hired risk. So if you were involved in the market after March 17th, you were kind of waiting for something potentially dumb and stupid to happen. And sure enough, you hit the snowbank, and it happened to be tariffs this time. I don't know if anyone knew it was going to be tariffs, but the likelihood of something happening was very, very high. I don't think to the degree at which it happened, we were down 10% in 2 days, right? I don't think anyone would have projected that. But yeah, the market hit an ice patch, and the market maybe could have been looking for anything. And this is what it has latched onto. You know, I know there's been presentations in the past. There was a lot of tariff worry in Trump's previous administration, and the market just zoomed right through it. Now, these seem a little bit harsher, and he's definitely digging his feet into the ground, but I think the market was already weak well before these types of the actual tariff news hit the headlines.
I think you already answered this, but I'll ask my first question. So referencing back to one of your podcasts on February 21st, the episode was called The Bearish Thesis. The timing of that episode was really, really good. It was basically at the top of the market. How did you know that that was the top?
Candidly, we didn't.
Oh,
We didn't know that was the top. It was just the case was starting to build when you take in like the weight of evidence of information that was happening, whether it's what the deterioration that's happening underneath the surface of the market. But the main driver in some of that discussion on that particular episode was the increase in credit stress that we were seeing across the bond complex. So the really, really smart people work in credit and bonds. It's not in stocks. And when you start to see credit tighten and liquidity in the market, because liquidity is the lifeblood of the market. If liquidity dries up, it's like an oil in the engine drying up. It causes the engine to seize. When you start to see things like CCC credit spreads of junk bonds getting sold and things like that, it means there's credit stress that's happening. And then I think in that episode, we highlighted some important levels that we'd want the market to prove that it could stay above. One of them being the January 1st price level, another one being the election gap, and then we subsequently not crashed through them, but moved through those pretty quickly. It was kind of a heads up that things were going to be a problem.
Dustin,
yes, sir.
is it fair to say that, not to what the point that Ian said about it being weak, and you saying that there was some intimate or, some dangers of a market being overvalued, the combination of that and the tariffs. It's not just the tariffs, right?
Yeah, his question is not, it's not just tariffs, and I would argue yes, you're correct. We may correct another 20%, and that tariff story is gone. Like, so the amount of times I've seen in the market where you have a narrative, this company is going to kill it in earnings. They kill earnings, like they just knock it out of the park, and the stock gets sold, or vice versa. Like this company's terrible, their earnings are terrible, and all of a sudden you see an earnings reaction where it goes the opposite way. You have to be open to the scenario that all tariffs are removed and the market continues to correct 20%. Well, then what other information was being digested that we're not seeing? It's a good question.
Okay, I'm going to combine two questions. So for the past 40 years, our industry has said you should always own some bonds, some stocks. They kind of to offset each other. The idea that bonds would be more stable at certain times. Is this still the case, or have things changed? And then are there other things besides U.S. equities that we should be paying attention to? Kevin?
So the last couple of presentations, I talked about fixed income. So it was a few ago, we talked about how the 60-40 portfolio had the worst, I guess, year in terms of performance that it's had in, I don't know, probably like 100 years. Because if you think about that picture we like to put on there with kind of like the teeter-totter, right? The relationship between prices of bonds and interest rates is interest rates go up, price of bonds decrease, right? If you have currently issued bonds out there in the marketplace paying 5% and interest rates rise to 7%, nobody really wants to pay you the same amount of money they would have a week ago for that 5% when they can go get 7% now. So bonds, right, essentially the rates, they're a little bit more stable now, but it increased over the last, few years, and we've seen, treasuries underperform drastically since then. So, I guess maybe that statement made sense 20, 30 years ago, because generally when you look at these interest rate cycles, they pretty are long-term in nature, right? Talking like 30, 40 years. Now that pendulum's kind of flipped and gone in the other direction, I mean, I don't think you can say that concretely, right? And things other than equities, well, really, we're not looking to participate in much of anything at this point. What was interesting when U.S. equities started to kind of sell off, the strength that we saw on international equities, even on an absolute basis, they were still moving higher at that point, which is pretty unique, at least since I've been in the industry, which is, the least out of these two. But since I've been here, that's been pretty unique. I think, international equities on a relative basis in some areas have still held up fairly well, which is interesting. So, maybe when things turn around, we start participating again, that relative strength's still there. Maybe international is the place to be. Bitcoin's held up, fairly well for the most part. So maybe crypto is something that we look at, but we'll see.
I think Kevin brings up a good point. So we call it diagnosing which beach ball is being pushed underneath the water. So when you look at red tape, so when it's just red everywhere, you just kind of want to look at what are the things that are holding up really well. And isn't it interesting that international is holding up well, right? Because if you think about tariffs, you would think that shouldn't be good internationally. Would that be something is if we enacted tariffs and for the next decade, international outperforms the U.S.? We're open to that because we're starting to see that. We haven't held a lot of international in portfolios for a long time, but maybe the next 10 years we will because of what we're seeing strength out of international recently.
Okay, with that we can transition to final thoughts.
Okay, excellent. I suppose we're right up against it.
Yes.
All right, very good. Oh, do you have a
I
clicker?
have a question yet.
Oh, question?
One more from Mom.
How do you see the consumer interest rate markets, like mortgages and whatever, affected with the volatility? Do you see any relief at all?
As someone who's currently in the process of buying a house, and as someone who looks at 30-year treasuries and mortgage rates a lot, no, I don't think. I think we're in a rising rate environment. We pushed it off for a while with the zero interest rate stuff that we did, the ZERP, and we kicked that can. And Dave and I talk about this a lot on the podcast, but the evidence continues to grow that the next 30, 40 years, interest rates go up. Now, they're going to go up at the same rate? No. Are we going to have 13% mortgages? I can't tell you that. But I do think that the low interest rate regime is done, unless the government wants to step in and say we're taking it all the way back down. That is always a possibility as well. But as far as what the markets say, no, higher rates.
Thank you.
Thank you. Yep.
All right, we'll wrap it up so people can get out of here. I always like leaving people with a couple thoughts. If you like this type of information, we do put out a weekly podcast. You can use that QR code to scan to get onto your favorite platform, whatever platform you like to listen. But we talk about it. It's very transparent. We talk about our thoughts. We talk about our process, what we're seeing. I highly encourage you to check it out. Keeping an open mind about outcomes. This is a flashback to a presentation we gave in 2018 in October. Tariffs were all the rage back then. We saw some early year volatility like we're currently seeing, and then we recovered. Late in the year we did sell off, but we're open to outcomes. And quite simply, using our process, if orange is above blue, we're going to be involved. So if the market has enough buying demand behind it, orange crosses above blue, it says roads are clear, we'll participate. And quite frankly, that could be for a week, and then it moves back down, we'll be back in the garage. Could happen. But that's our game plan. It's better to have a process than a prediction. But we'll participate in growth when it's apparent. We'll have the cruise control on. But if not, we're going to be parked. Some important levels that if you like to look at home, if you're following the S&P 500, this 5,600 to 5,800 levels in the orange box is hugely important. because that's when a lot of this selling really started to amplify here. It's also below a 200-day. It's a really big behavioral level for the market for buyers to get price to go through. If we can clear that, that'd be huge. That'd be one for the nightstand. If you're bored and you want to look at a chart, this would be one to look at. Okay, this is where I want you to try to go ahead and scan this QR code, because it's going to take you to a one question survey, and it's about how likely are you to recommend adaptive education like this presentation to a friend or colleague. Doesn't mean you have to, it's just how likely. You'll notice that a 9 or a 10 is a smiley face. I like the presentation, I could see how my friend would benefit from this. The red ones are frowny faces. I hated this presentation, it was terrible. You can give us that ranking too. I don't want you to, but you can. But it's a really one question, so if you could scan that for us, we're trying to collect this data in real time. Do that, record your answer, it's legitimately, scan it, click a number, click submit, you're done. I would appreciate it. Congratulations to our tax team. You can hear the huge sighs of relief in the back of the room from our tax team. 1,400, over 1,400 taxes done this year. Tremendous job by them. They helped a lot of stressed out people become organized, and now they get some relief themselves. They put in a lot of hours. So if you could give them a round of applause, I think that would be appropriate. Thank you, guys. One quick announcement, there is a new client portal coming soon. There's not a date set, but look for communication on that. We're excited about that because we've been kind of running into some issues on how data was being presented in our prior tech provider. We found a new one, Kevin and Brad, and their team have been working hard to get a new one off the ground. So look for emails and communication on when this new portal is available. And with that, I'll hand it back over to Justin to close this.
Then if you could go through the normal process of filling out our feedback. So again, just letting us know how we did. Many of you have your upcoming annual strategies already scheduled, but if you're new to us and you want to schedule initial consultation, you can indicate that. So there are places for notes on there, so please submit that. And then if you're new to us, and you want to schedule initial consultation, there's no fee for it. We don't do any planning. It's just an opportunity for us to learn more about your situation and see what type of planning you may need to do. And then we go over our planning process and cost structure. Next month, we have insurance. So our insurance agency team will come up and they're gonna give you a bunch of education on insurance. So we're excited about that. Thank you much.
Great rest of your day.
And one round of applause for the food. It was great.